Futures contracts explain for beginners how futures trading really works. Have you ever wondered what a futures contract actually is? If you heard traders talking about NQES, gold, oil, or other futures markets but never fully understood what they're trading, this video is for you. Today, I'm going to explain futures contracts in simple terms, show you how they work, why traders use them, and how beginners can start learning futures trading. This video is for educational purposes only and is not financial advice. My goal is to help you understand futures trading from the ground up. If you're interested in futures trading, day trading, or learning how the financial markets work, make sure to subscribe and turn on notifications. Let's get started. A futures contract is simply an agreement between a buyer and seller to exchange an asset at a future date for a predetermined price. Now don't worry, most day traders never actually take delivery of anything. If you're trading stock index futures like the Nasdaq or S&P 500, you're simply trading the price movement. Think of a futures contract as a financial instrument that allows traders to speculate on whether prices will move up or down. Futures contracts were originally designed to help businesses manage risk. Imagine you're a farmer growing corn. You don't know what corn prices will be 6 months from now. To protect yourself, you can lock in a selling price today using a futures contract. At the same time, a food company might want to lock in a buying price to protect against rising costs. This is called hedging. Today, futures markets are also used by speculators who trade price movement for profit. Some of the most popular futures contracts include a mini S&P 500 ES, a mini Nasdaq, a crude oil, a gold GC, a silver, a treasury bonds. Many day traders focus on ES and NQ because they offer excellent liquidity and active price movement throughout the trading day. Let's keep this simple. If you believe the market will go higher, you buy. If the market rises, you profit. If you believe the market will fall, you sell short. If the market drops, you profit. One of the biggest advantages of futures trading is that traders can potentially benefit in both rising and falling markets. To understand futures trading, you must understand ticks. A tick is the smallest amount a futures contract can move. Every futures market has its own tick value. For example, when the Nasdaq futures market moves several ticks in your favor, those ticks translate into profits. When it moves against you, those ticks translate into losses. Professional traders think in terms of risk per trade rather than dollars they hope to make. Futures trading offers leverage. This means traders can control a larger position with a relatively small amount of capital. While leverage can increase profits, it can also increase losses. This is why risk management is critical. Many beginner traders blow up accounts because they focus on leverage instead of capital preservation. Here are the most common mistakes. Number 1, trading without a plan. Number 2, taking oversized positions. Number 3, moving stop losses. Number 4, revenge trading after losses. Number 5, ignoring risk management. Remember, successful trading isn't about being right all the time. It's about protecting your capital while letting winners grow. If there's one thing I want you to remember from this video, it's this. A futures contract is simply a tool. The real key to success isn't the contract itself. It's how you manage risk, control emotions, and execute your trading plan consistently. Master those skills, and you'll be ahead of most new traders. If you found this video helpful, hit the like button and subscribe to Futures Flux for more futures trading education. Comment below and let me know. What futures market are you most interested in trading? NQES, gold, or crude oil? And remember, protect your capital. Follow your plan. Trade smart. Educational content only, not financial advice. Trading futures involves risk.